Hello and welcome to Business Incorporated live on Channels Television. It's a TGIF trading session. Here's what's coming up in the next 55 minutes. And it's still inflation reporting season, and Kenya follows South Africa with a CPI drop to 2.7%. That's the lowest in the last 17 years. And the South African Reserve Bank cut its repo rates by 25 basis points, getting firmer in the rate-cutting cycle. Plus, Ethiopia and Tanzania reach an agreement to trade electricity. It's great to have you join us. I'm Laddie Williams. Let's get a check on what's playing out with the commodities market. Now, we'll see gold prices. That's heading for the best week in a year. That's today, supported by safe haven demand amid further escalations in the Russia-Ukraine war. And we'll see that right there, 0.7%, $2,688 per ounce. That's what's playing out right there in the spot gold market. For U.S. gold futures, 0.6%, over 0.5%, $2,627 per ounce. And we're still seeing gold, still shining at this point, even though the U.S. DXY, that's the dollar index, that also started another rally at this point. And we know that inverse relationship between commodities and the dollar. We're still seeing gold there rising, being that safe haven asset. Let's get a check on the oil market now. We'll see oil prices also looking good, right at 0.1%, $74.33 a barrel. That's for Brent. WTI crude, that's 70. I'm trying to get back that $70 level, $70.23 a barrel, 0.2%, a bigger move up. We know that's the grade that the Dangote Refinery likes to import at this time. So prices going back above that $60 level. And now we see the federal government has successfully raised over 346 billion naira in its November 2024 bond auction, and marking a significant increase in allotment despite a reduction in the total amount that was offered, held on November 18, 2024. By the DMO. The auction included reopenings of 19.30% FGN, APR 2029 5-year bond, and the 18.50% FGN February 2031 bond. This auction saw a 33.33% decrease in the amount offered compared to October, with 60 billion naira allocated for each bond, down from 90 billion naira in the previous month. Despite this, total allotments rose by 19.50%, increasing from 289.597 billion naira in October to 346.15 billion. The 5-year bond received an allotment of 63.53 billion, while the 7-year bond attracted 282 billion naira. And conversations about boosting financial inclusion in Nigeria are becoming more apparent as the Tinubu administration aims for a $1 trillion economy. Well, at this point, stakeholders in Nigeria's financial services industry believe Nigeria has improved so far, but more needs to be done. I had a conversation earlier with the managing director, CEO, eTransact PLC, and he believes that technological advancements in Nigeria have come a long way, but cash will play a minimal role. Take a listen.
To bring people that have never trusted brick and mortar financial institutions into the financial services ecosystem. And then you expect them to go to a complex machine looking like a robot they have no connection with. Meanwhile, you compare that with Mama BC, who has a POS, who sells fish, rice, and medicine, every other thing in that village ecosystem or that rural ecosystem. You see that person. Look, a research was done several years ago about Nigerians and currency. Our culture, I think the research was done in 2012. Our current culture, there is a need to touch currency. So that affects cashless in Nigeria significantly. And it also has to do with trust. Look, you owe me money, or I owe you money. You gave me money a while back, and I have to refund you. I want to look you in the eye as I refund you, so I'm giving you that money. So you don't want any situation where I tell you I've transferred it, you've not seen it, and then I'm like, dude, I've done this. Where is the money? So that trust is critical, and the convenience is critical.
And as International Fraud Awareness Week, that's winding down, stakeholders have highlighted the need to educate financial services customers on ways to avoid being scammed. So for this reason, FITC put together a roundtable, and top on the agenda was the role of artificial intelligence in mitigating risk in Nigeria's financial services industry. Take a listen.
It's the FITC Risk Management Roundtable, and present here are financial services industry players, regulators, and stakeholders. And the theme is leveraging AI for financial fraud detection and regulation.
Institutions like JP Morgan Chase and HSBC, as we know, are currently leading by example, leveraging artificial intelligence to mitigate fraud and enhance compliance frameworks. Bringing that closer home, Africa's dynamic financial services landscape, as we do know, is characterized by quite a lot of digital threats.
This roundtable meeting coincides with International Fraud Awareness Week, as stakeholders make efforts to minimize the impact of fraud by promoting anti-fraud awareness.
The theme is both timely and appropriate, considering the need for financial institutions, operators, regulators, and supervisors to safeguard the stability of the financial system amidst the rapidly evolving financial landscape. Our discussion will also focus on one of the most critical issues threatening safety and soundness of our banks, our economy, and the global financial economy. Financial fraud, and particularly how artificial intelligence can be used to mitigate its associated threats.
Participants believe educating the public with current fraud trends will help keep financial services customers on guard.
Big international players in the capital markets have also fallen victims, through the use of business email compromise schemes. So it has become imperative, therefore, to put in place, measures to ensure that the capital markets players, especially the consumers, are properly educated, and awareness is created, so they don't fall victim to all the latest trends of fraud.
FITC, an establishment by the Nigerian Bankers Committee, is at the forefront of advancing knowledge, innovation to minimize risks that arise in Nigeria's ever-evolving financial services industry.
FITC. FITC.
And now to our first conversation. We see the drama surrounding Nigeria's ability to refine its own oil continues as the Nigerian National Petroleum Company Limited continues to miss deadlines on bringing the Port Harcourt Refinery on stream. Well, joining us to discuss the impact on Nigeria's economy is Dr. Muda Yusuf, the CEO, Center for the Promotion of Private Enterprise. Great to have you on the show. Happy Friday, sir.
Thank you, Ladi.
So,
to be with you.
Great to have you, Dr. Yusuf. So, we see the NNPCL admitting to challenges with the delaying of the Port Harcourt Refinery takeoff. So, I'd like you to paint a picture to how much funds these refineries are consuming, even in this state of no production and missing deadlines.
Well, I think there is already a consensus, even in government, that the model of managing our refineries needs to be reviewed. Because we have since realized that getting the public sector alone to manage the refineries had not worked for us. And that is part of the major challenges that the economy has been facing. That is one of the major factors responsible for the current macroeconomic challenges that we have: weak reserves, weak currency, and all these other macroeconomic issues arising from that. So, and I've heard, I think, either the Minister of Petroleum or GMD of NNPC saying that henceforth, going forward, the private sector, the NNPC will work with the private sector to manage the refineries. And for me, I think that is the way to go. Given the experience that we have had with the turnaround maintenance, even the cost that has been incurred over the years, and more importantly, even the fact that we have not been seeing much of value for money. The refineries have been down for close to 8 to 10 years. Of course, that is not sustainable. So I think we need to work around that consensus as part of the holistic reform for the oil and gas sector. We can look at other models, PPP models. It could be concessioning. It could be the NLNG model where there's partial privatization. It could also be full privatization, whatever it is. Certainly, the current model is not working. And I believe that the current management of NNPC and even the government, has bought into that idea. That is the way to go, really.
And talking about maybe an outright sale at this point, do you think they're ready buyers, for this state-owned refineries?
No, of course. It depends on the value. Now, by the time the work at all the refurbishment and rehabilitation of the Port Harcourt refinery is completed, I'm sure the value will have been significantly enhanced. So that way it will be easier to get a private sector partner. And for that refinery that have not worked for some time, again, it depends on what price you place on it. Once the price matches the value of the asset, of course, you get people to buy it. What is important is to get those refineries to work for the economy. Because this perpetual dependence on importation has done a lot of harm to the Nigerian economy. When we talk about forex issues, we talk about foreign reserves, we talk about inflation, we talk about revenue. A whole lot of it, has arisen as a result of the way that this sector has been managed. So I imagine that as part of the ongoing reforms, we will see a lot more pushback in terms of direct operational activity by the NNPC and government operation, and more engagement of the private sector, especially with respect to the management of these assets. And that way, we'll be able to get more value from those assets. And that is what is paramount, to get more value, to get them operational. How much we get from them is not as important as getting them to work and getting them to give some value in terms of jobs, in terms of employment, and more importantly, in terms of backward integration, in terms of energy security. But that is what is most important at this time. And the savings that will arise will not just come from the reduction in the importation of petroleum products. There's a whole lot of benefits even to the industrial sector. A whole lot of raw materials that will come from these refineries. So importation of raw materials, even by the industry, will also reduce. So there's a whole lot of benefits around it. And we need to be very deliberate and act very, very quickly, to ensure that we go along this route as part of the total package of the oil and gas sector reform.
Looking at the deadline misses so far for the Port Harcourt refinery, do you think it's some kind of miscalculation from the NNPC Limited, or could it be that they didn't gauge well, the scale of work required for bringing this refinery online?
Well, I think possibly, there was no proper evaluation of the volume of work or the challenges that it will entail, to bring the refinery, up on stream. From the statements I read by the communications person, I think there were a lot of unforeseen risks and challenges. I think that was how he put it, that they were encountering that had led to this series of shifts. But we are hoping that at least at some point, let's give them more time, they will fix it. But going forward, the model of operation needs to change. I think that is the only enduring solution, to all these hiccups that we have been having with the refineries.
And going into 2025 and beyond, what are you seeing for Nigeria's refining capacity, when it comes to, refining our own oil at this point? And we're seeing a lot of volatility, in the oil market. Today it's supply disruption, tomorrow is demand expectations. But definitely Nigeria needs to start positioning, for what's to come, in that market. So what are you seeing for refining, going forward with all of these dramas that we still keep seeing at this time?
Well, the good news is that the capacity for local refinery is improving. We have seen what the Dangote refinery is doing, which is very commendable. We have seen the initiatives by the NNPC trying to put back on track some of the NNPC refineries, and hopefully subsequently get a public partnership model to continue to run them, so that we can avoid the political economy issues that have been impeding the progress of those refineries. I think that is very, very fundamental. Then, of course, we have seen some other modular refineries and all of that. But what is important in all of this is to give the right kind of policy support, because that is the way it is done all over the world. To support indigenous manufacturing processes and all of that with policy, especially fiscal policy. So if we have that, we'll get a lot more of these refineries to come on stream, and we'll be able to stimulate a lot more private sector interest, even in the NNPC refineries. Because what is important is the policy environment that we create to encourage this kind of things. That for me is the way to go. We need to give a lot more fiscal incentives, to be able to make them competitive. Because we are not just looking at domestic markets, we are looking at the regional market, we are looking at the continental market. Already we are in the threshold of this African continental free trade area. We should be able to be a dominant player in the oil and gas sector, because we have the personnel, we have the entrepreneurs, we have the natural resources. So with the right kind of policy support, we should be able to leverage on all of this to be able to, leapfrog the economy in so many ways. So that for me, I think the outlook for me is bright, but we need the right kind of policy support to be able to unlock all of these opportunities and potentials in that sector.
All right, Dr. Yusuf, let's pivot now. It's rates setting season right now is upon us again, and we've seen some African countries report their inflation numbers for October. We've seen the likes of South Africa. They saw a reduction in their inflation rate. We've seen with Kenya also inflation coming down in those countries, and now South Africa is cutting rates at this point by about 25 basis points. Well, it's not the same picture in Nigeria. And next week we'll have an MPC meeting. What are you expecting, and what is this telling us? Seeing other African countries kind of like meeting their inflation targets and already cutting rates.
Well, there are two sides to it. What I expect is different from what is likely to happen, because we need to situate our expectation also within the context of the mindset or the disposition of the monetary authorities. What I expect personally is that we should, avoid for now hiking of rates, because we are almost at the limit in terms of monetary policy instruments, using the instruments to tackle inflation. Already interest rate is over 30%, which is bad enough by any standard. Our cash reserve ratio is already 50%, which is also challenging enough. Our MPR is 27%, over 27%. It's one of the highest in the world. So for me, I don't think we need to push this any further. If the objective is to tackle inflation, I think we should be looking more in the direction of how do we scale up productivity? How do we support production? How do we give fiscal incentives? Because what the economy needs now is to address the issue of productivity and production, not to further tighten the operating conditions for businesses. That, for me, I think is very important. And when we are talking about also fighting inflation or dealing with liquidity, we should also look more in the direction of the fiscal policy, because we have talked severally about fiscal and monetary policy coordination. If the fiscal policy angle is generating a lot of liquidity, and the monetary policy is mopping up the liquidity, and the private sector is suffering the consequences of the mopping up of liquidity, then it's a challenge for the economy because you are stifling growth, you are stifling investment. And this is a situation where there are so many headwinds that businesses are grappling with. So for me, what I will expect or what I will propose is that for now, the CBN should put on hold any tendency to increase rates if it cannot reduce the rates. Then we look more in the direction of fiscal policy. We look more in the direction of the economic stabilization bill. I hope that will also come up very quickly so that we see the kind of incentive that the fiscal policy constituency is also bringing to the table. Because we need to reduce operating costs. We need to reduce production costs. Even if that will entail trading off some revenue, so be it. Because we need to create an environment to create more wealth, to generate more jobs. So for me, I think we need to deploy a lot more of these fiscal policy tools to address this inflationary issue rather than committing more to this inflation targeting or this monetary policy tightening. That is my expectation.
Right. What do you think we can learn from countries like Kenya and South Africa that are already nearing their inflation targets and already cutting rates?
Well, I think what we can learn is to look at it holistically, because tackling inflation is not just a monetary policy phenomenon. So I imagine that in these other countries, a lot is happening around their fiscal operations. Because the way you manage your fiscal space will also determine the kind of outcomes you get in the monetary environment. So I think they are doing a lot in their fiscal space, reducing fiscal deficits, managing their expenditure, reducing exposure to debt, and so on and so forth. Those things are critical. So that way you have better complementarity, between the fiscal arm and the monetary arm. I think that is one key thing that we can learn, from these other countries.
All right, so we know another season that's right here is budgeting. We see the federal government and state government setting up budgets for 2025. We've seen for the federal government about 47 trillion. That's what they're looking to spend in 2025. Then the Lagos state government is looking at 3 trillion. They're the trillion level. That's for Lagos state. The governor presented that yesterday. How do you see all of this playing into, inflation and debt levels, going into 2025?
Well, we need to moderate the borrowing component of the budget. I think that is extremely important. Now, over the last 10 years, our public debt, I'm talking of public debt, not the national debt, has grown by over 900%. In 2015, our total debt was 12.6 trillion naira. As we are speaking now, our debt is 134 trillion naira. That's over 900% increase. These debt levels have serious implications for the macroeconomic environment. When we are struggling with the macro issues, these are also part of the problems. Because if debt is rising at a rate that is not commensurate to output, it creates a lot of macroeconomic issues. And if the cost of servicing the debt is also increasing, it's also an issue. Because before now we have prided ourselves as, doing well with respect to some key ratios in terms of debt to GDP. For many years, our debt to GDP was less than 30%. At the time, it was even 20%, 18%. And at that time, we were saying that we still had more room to borrow. But right now, our debt to GDP ratio is over 50%. So this is the time to begin to watch it so that we avoid the risk of getting into a challenge of debt trap. We avoid the risk of kicking the can down the road, because we also don't want to create challenges for future generations. So we need to watch it very, very carefully in terms of the debt particularly foreign debt, because of the exchange rate movement. Because these debts have grown so significantly again because of the exchange rate. So by the time you convert the dollar quantum of the debt into naira, you are dealing with a very, very big figure. And this has implications for debt service. And if the debt service is too high, it has a crowding out effect on the funding of infrastructure and funding on some other critical aspects of the economy. And of course, it has implications for the crowding out effect of the private sector of the financial market. So these are the wider implications. So we need to make it slowly. We need to look at it properly to ensure that we don't create more problems as a result of either the size of borrowing or the size of spending and all of that. So we should work more a lot towards fiscal consolidation. And more importantly, we need to create the policy environment to grow investment, to grow the GDP, to encourage more private sector. Because budgeting is about appropriation. Creating the right kind of environment for businesses to thrive is a fiscal policy matter. Your tariff policy, your tax policy, your regulatory policy, those things are critical. They are as critical as the budget. So as we talk about budget and appropriation, we should also be talking simultaneously about how we create the environment to complement the objectives of the budget. To encourage more private capital to come into the space.
All right. So, talking about debt levels, one government comes in, another one then leaves, and another one, comes. And, most of the time, different governments rake up, different amounts of debts, and you end up passing it on, to the incoming government. So I'm wondering, do you think the political class understand the ramifications of just, passing on these high levels of debt, and at what point can they be checked?
No, you see, we need to have a national approach to issues of economic management and macroeconomic management. There are policies and frameworks that should outlive any administration in terms of some fundamentals in economic management. So we should have, you have ratios, which are global ratios that have been accepted as, the threshold that you should stay within. Either you are talking about debt to GDP or you are talking about debt service to your revenue. Those are critical ratios. And these are standards. So as much as possible, no matter which administration is in power, we should adhere to some standard best practices in terms of economic management. Of course, that is very important. And we also need to take into account the vulnerability of the economy to exchange rate movement. That also has implications for debts. Because if foreign debt is growing and exchange rate is depreciating, it's a moving target. We'll be struggling to be able to pay. Some state governments now that have taken loans maybe 10 years ago, 15 years ago, with the kind of, that took foreign loan, with the kind of depreciation, many of them are struggling now for debt that their predecessors had incurred. And for some of those debt, they can't even find any serious value. But again, the burden of servicing those, they have become very, very burdensome to some of these states. So the same thing should apply to the federal government. So you should have a long-term view of economic management. That is why we have development plans. That's why we have 10-year plan, 50-year plan. So that no matter the administration, even if we are going to bring some variance, the variance should not be too significant as far as the economic fundamentals are concerned.
All right, Dr. Yusuf, but before I let you go now, let's just fast forward, to the end of the term of this present government. Where do you see our debt levels, going by the body language of this government?
Well, it is very difficult to predict because some of these things, I think from time to time, we need to review our approach to some of these things in the light of the implications, in the light of the impact on the economy. Secondly, if going forward we're able to improve on our fiscal consolidation, by fiscal consolidation I mean the capacity to generate revenue without necessarily putting more pressure on economic players and on the citizens. If we're able to make that progress, maybe efficiency in tax administration and all of that, that may also help to reduce some of these pressures, in terms of debt accumulation. So fiscal consolidation is about also managing expenditure and also trying to optimize revenue. So those two sides of the equation are extremely very important to ensure debt sustainability. So I'm hoping that as we progress, the administration will take into account, and the economic advisors too should take into account some of these variables and the implications for the economy. I think that is what is most important.
All right, thank you so much. It was great having your perspective, Dr. Muda Yusuf, CEO, CPP. Thank you for sharing your Friday afternoon with us.
Thank you very much, Ladi. Thank you.
All right, we'll take a break now. When we come back, we'll head straight to the markets, how the local bourses are performing and most of the global markets that we track. That's in a moment. Just stay with us. Welcome back. Well, I'll be sitting in for Anita now for the markets. Let's see what's playing out in Africa. We'll see mixed sentiment there on the African continent with the NGX still trying to decide, where I'm going to go. That's talking about the NGX, but we're seeing weakness right there in intraday, 0.21%, 97,000. So the 98,000 level, that's gone for now at intraday. But we'll see what plays out at the end of trade. We still have till 2:30 to figure that out. For the GSC in South Africa, 85,000 is also down, but marginally 0.07%. All right, let's bring in Orji Emmanuel now as a fixed income dealer, Access Bank, to bring us up to speed of what's playing out right here. Great to have you on the show.
Hi, Larry. Thanks for having me.
So we're seeing the federal government 2024, that's a November bond auction. Talk to me about the number and how it compared to one in October.
Okay, so on Monday, the federal government held this monthly bond auction for the month of November. At the bond auction, we saw the federal government offer 120 billion across two maturities, the 29s and the 31s. In terms of participation at that auction, we saw over 300 billion worth of subscription, and the federal government also sold those close to the amount or bid at that auction. That led to an marginal increase in rates on both the 29s and 31s. We saw the 29s close at 21%. The October auction, that closed at 20.75%. So pretty much a 25 basis points increase there. For the 31s, we saw that close at 22, which is a record high looking at the bond auctions historically. And that also increased by roughly 25 basis points. So we saw increase across board. Post-auction, we have been seeing some slight demand coming for the 2031, with trades being consummated at 21.95. Market participants are a bit cautious because of the MPC next week. So everybody is pretty much waiting to see how hawkish the MPC will get in order to participate more in that bond auction.
Right, all eyes on the MPC next week. But how would you gauge performance so far in the fixed income market this week?
I think I would just say there's just been a cautious trading session, both in the NTB market and also in the bond market. Both markets having auctions. The bond market had the auction on Monday. NTB was on Wednesday, and we saw further increase in stock rate as well, particularly on the long end from 23% to 23.5%. So I think markets are a bit jittered with, what's the plan? The government seems to be overselling, both on the bond side and also on the NTB side. So everybody's a bit cautious. But nevertheless, for the NTB market, we've been seeing some real money demand coming. The auction closed at 23.5, but we're seeing trades being consummated at 22.8. Things just showing you the continuous demand from both pension funds, asset managers, and also the retail investors looking to take advantage of that attractive yield. If we look at it at 23%, the yield is roughly at 29. So just imagine investing your money and earning 29%. It's more of like MMM at this point. So we've been seeing a lot of a lot of investors looking to cherry pick those attractive yield.
Yeah, talk about attractive, 29%, quite attractive, I must say. But the scenarios are going to play out. That's for Tuesday when we have the decision for the last rate setting meeting for 2024. So what do you think a hold would mean for the markets, or another hike, maybe 25 to 50 basis points? What are scenarios you're expecting?
I think a hold would renew a bullish bias in the markets, because what markets are expecting, like given the inflation numbers, based on consensus expectations so far, markets expecting a 25 to 50 basis points hike in the NPR rate. But if that doesn't happen, I think we'll see a renewed buying sentiment across board. There's a FAC inflow coming in this today or earlier next week that will most likely drive that buying sentiment. But however, we see a surprise hike, a high greater than 25, a high greater than 50 basis points at that MPC on Tuesday. We'll see markets going back to the shell, and expecting yields to continue to increase on the back of this. On the back of the hike or that we might see on Tuesday. But nevertheless, there's still that Eurobond conversation that's currently going on. They recently got the approval of 2.2 billion to issue for external borrowing. Most market participants are expecting that there might be an Eurobond issuance in December. That's based on expectations should ease pressure on the domestic borrowing. But nevertheless, a lot of interesting things to see moving forward.
And definitely, we've heard analysts, say that, or the government actually did say that this Eurobond borrowing would help, bolster our foreign reserves. So, what are you seeing for the Naira this week? Is it going to be a gain or a loss for the total week trade? And what are you seeing going into next week for the Naira?
So I think this week we've traded relatively flat. We saw the CBN intervening in that market yesterday, where they sold to some selective banks. I think that's what we'll continue to see moving forward, where we'll remain stable at 1670 to 1680, and the CBN continue to intervene, not aggressively, but marginally to some selective banks in order to provide more supply into that market. But nevertheless, the demand pressure remains persistent. We continue to see that every day in the FX markets. So a possible successful outing at Eurobond auction, Eurobond issuance next month should definitely drive more confidence in the Naira. But nevertheless, market will be waiting to see what rate the government will be able to get those funds at, and the amount of size that they issue as well.
Right, and it seems we've not really seen sales to the BDCs.
I think at this point they've kind of locked out the BDC from that space. We saw them aggressively doing that, sometime mid this year, when they resumed that BDC sale in order to meet retail demand. But I think after that massive sale of 800 million that they did, but we have not really seen anything going to the BDC. So I think it will be interesting to see the comments that they make at this MPC meeting regarding what they look to do in the FX markets, not just on the official market as well as the BDC market, to see if we're going to see a resumption in the sale of BDC, because when that happened, that kind of helped in the appreciation of the Naira. But since that have not happened, we've seen that massive spread between where the official market is trading and where the parallel market is trading. I think currently the parallel market is roughly at 17.5, 17.4, while the official market is still at 16.8, 16.7. So you see that 60 to 70 Naira spread in that market, all on the back of the fact that we've not been seeing some decent supply going into that BDC market as well. But definitely will be interesting to see how the monetary policy address this concerns for markets if the supply will just likely still remain with banks without and also shutting out the BDC market.
All right, we'll see if the BDC's got some action, at some point. But thank you so much. It was great having your perspective. Oji Mano, the fixed income dealer at Axis Bank.
Thank you for having me.
All right, now let's get a check on what's playing out with other markets. Now we'll see in the U.S. For the stock futures, they edged lower today with Wall Street poised to end the week with gains in three major averages. But we'll see the Dow Jones Industrial Average at the time of taking these numbers there, 0.03% up, 0.04% down for the S&P 500 futures. Then we see the tech-heavy Nasdaq. That's a big 0.18%. So the moves in futures come after a modestly positive day on Wall Street. Yesterday, the Dow rose about 462 points. That's about 1%, and the S&P added about 0.53%. Nasdaq was, little change, closing at marginally down, but we're seeing a more convincing opening. That's for the Nasdaq futures. All right, let's get a check on other markets we track. Now we're seeing Asia. It's mostly markets mostly rose in Asia today. 0.68% for the Nikkei, 38,283 points. A convincing 1.89% rise there for the Hang Seng Index at 19,229 points. Other markets we track in Asia. We'll take a look at the Nifty 50. I see there's a recovery there, 1.54%. 23,707 points, and the Shanghai Composite, big drop there, 3,267 points, 3.06% to close. That's for the markets in Asia. All right, let's see what's playing out in Europe now, and we know the German auto sector has seen some trouble for a while now. That's talking about Europe, and the negative headlines, they just keep coming at this point, and that's what we're getting right there from Lars Holter with the cost for suppliers. That's been quite volatile for now. But let's talk to Lars Holter. Now, great to have you, Lars. So what are you hearing?
Thanks for having me, Ladi. Well, first of all, the company we're talking about is Bosch, truly a storied German industrial company. They're a household name because one of their fields is power tools and household appliances. So I would say there's not many Germans who don't have a dishwasher, a dryer, a screwdriver, or a circular saw that doesn't bear the name Bosch. But much more important is their automotive supply business, ranging from powertrains to electronics and mobility solutions. That's the business they're having problems with right now. And so Bosch is asking workers to cut their weekly work hours from between 38 and 40 down to 35 hours, and obviously make less money than too. Now that hurts workers, of course, and management admits that they don't even know if it will be enough. But the CEO says for now that it's better to cut hours than just let people go. And that had been on the table for a while, with up to 7,000 jobs on the line.
So what exactly are the problems that force Bosch to take steps like this?
It's all about the automotive business. That's still in pretty bad shape. It just takes a quick look at the headlines just from the last 2 days. Volkswagen is cutting jobs and threatening to close plants. Employees there are planning a strike. Some have offered to work for less money if at least plant closings can be avoided. Mercedes-Benz has just announced a cost-cutting program that's supposed to save billions. They didn't say anything about job cuts, but those might come anyway. And Ford has also said that they will let 2,000 people go at their German plant near Cologne. That's after the US firm has invested 2 billion euros there. They say that sales are low, and we've been seeing this for a while now. The switch to electric mobility, as well as competition from Asia, is weighing heavily on car manufacturers here, and like we're seeing with Bosch, it's affecting other companies as well.
What are investors looking at in today's markets?
Well, our biggest breaking story of the day comes out of Politics. The party that led our now failed three-party coalition has finally agreed to send Chancellor Olaf Scholz back into the race when we're having snap elections early next year. It's interesting because after a days-long debate over who will be the candidate, Scholz and everyone else come out damaged. So that's certainly something that will be discussed everywhere today, although it will not have direct implications for markets. But to be fair, there's not too much else on the docket today. Some industrial numbers out in the US and some more ECB talk in Frankfurt. Today, they're discussing the future of the finance sector in general.
Lars Holter, thank you so much.
Thank you, Ladi.
All right, now let's get our stories now. Coming out of Africa, we see President William Ruto boasting of his administration's economic turnaround in the last 2 years, following the drop of the inflation rate from about 9.6% in September 2022 to 2.7% in October this year. The president expressed that the inflation rate is the lowest witnessed in the country in the last 17 years, which his government has drastically reduced despite the local and external economic outlook that have spelled doom in the country. In the State of the Nation to both houses, he assured that the macroeconomic indicators were poised for a positive turnaround under an upward trajectory in the economic indicators, including the shilling performance and other indicators. All right, so we see the South Africa continues to be one of the world's most unequal countries with stark income disparities and an economy that fails to be inclusive for all economic participants. The economy is highly concentrated in many sectors with significant barriers to entry for micro, small, and medium enterprises. Could the township economy hold the key to addressing the country's high unemployment rate? Well, our South Africa correspondent, Innocent Samosa, has more.
In South Africa, approximately 40% of the working age population and 60% of the country's unemployed reside in townships. The apartheid planning system resulted in townships. The Township Entrepreneur Alliance, or T, is celebrating its 6th annual Township Economy Summit. Founder of T, Bulelani Balabala, says it aims to be the driving force behind South Africa's township and rural entrepreneurial ecosystem.
I believe for a fact that if we're looking for GDP growth, part of the economy that we need to really stimulate and support is township businesses. And these micro enterprises are the backbone of the economy, and I believe that without a shadow of a doubt.
He also outlined specific barriers macro, small, and medium enterprises face in South Africa.
I think one of them is the rise in crime, in the township. Because you find that depending on where you are in the country, right, you're either suffering from extortion or just petty crime. But over and above that, it's really the access to information. And I think to most people, whenever I bring this up, it sounds a little bit strange, but in reality, the information that you have when you're a privileged individual versus the information that ordinary individuals have is totally different.
But what role can local businesses in townships play in alleviating South Africa's high unemployment rate? Lizzie Mohali is with Nedbank Retail and Business Development.
Oh yes, I think conversations are very important. One of the biggest drivers of innovation is bringing different minds with different perspectives to come share ideas, to come build on each other's ideas. Earlier on, I spoke about imagination. To say when we come here together, let's imagine what's the future of township economy that we want to see. What is the future of businesses that we want to see from our townships? Right? Imagine if one day we have a township economy business that's taking over the world.
Entrepreneurs here are optimistic about the future of SMMEs in the country.
The future of the township economy is very bright, my brother. People are waking up to it, And once again, I would like to see that also as the people of the townships, of the rural areas, being at the forefront of that economy.
As South Africa looks for solutions to its high unemployment rate and economic inequality, the township economy could play a pivotal role in creating more inclusive opportunities. From Johannesburg, South Africa, Innocent Samos, Channels Television News.
Thank you, Innocent. Meanwhile, we'll see the Monetary Policy Committee of the South African Reserve Bank that cut its repo rate by 25 basis points, bringing it to 7.75% and the prime lending rate to 11.25%. Putting them firmly in that rate-cutting cycle. Then we see Ethiopian Electric Corporate Communications Director has indicated that Ethiopia plans to supply 100 megawatts of electricity to Tanzania once all agreements between the countries are finalized. So all eyes on that agreement and for the electricity trade. Let's get a check on what's playing out in the crypto market. Now we're seeing it's mostly green. In the crypto market, we're still seeing new highs, but Bitcoin taking a breather there, but still $98,777. And Ethereum, deep red, the king of the altcoins, XRP, doing really well. Let's look at the Fear Greed Index that shows how investors feel. And 94 points. Extreme greed, that's what we're seeing in the market right now. We know how some investors like to use this indicator. Let's look at the top headlines now. I would say the UK is set to finalize crypto regulatory framework, and the announcement was made during the city's Financial and Global Tokenization Summit that held in London. The timeline follows a delay caused by a general election earlier this year, which brought a change in government. And we've seen XRP hitting a new high, about 71% up so far. Then we also had that Gary Gensler resignation news yesterday. So that might be propping up the market like we see today. Let's bring in Gilbert Jokwata now, financial market analyst. Hello, Gilbert.
Greetings, Mr. Ladi. Good afternoon.
Yeah, so I guess the euphoria is getting stronger and stronger. This bullish euphoria, we're seeing extreme greed in the market right now. I don't know, what the expectations, I don't know, it's still bullish, right?
It looks like it's another day, another all-time high for Bitcoin.
Right.
Bitcoin keeps soaring and creating new all-time high. My own exchange right now, it's sit at 99,400, but in most exchanges, they have hit the 100,000 milestone. I don't know if you're aware of this.
Wow. So multiple prices in different exchanges at this point.
Yes, it's more like an arbitrage price right at the moment, because different multiple prices on different exchanges. But then we haven't gotten to that consensus $100,000 where all the multiple exchanges, hit that mark. And so it's more of a question of, will Bitcoin, have a consensus, $100,000, a consensus of $100,000? And I think that's yes. This will happen in a matter of hours or just days from now. And you also know momentum drives the rally. Of course, I still expect short-term corrections. There remain a possibility in the bull market. Short-term correction is always part of it. But we remain bullish on a 1 month. Price awareness is growing. The more price become like something that speculators stock up, the more persons also rush into the market. And one of the most prominent factor propelling Bitcoin surge is also institutional interest, particularly through the ETF. And then another significant factor is that of the Donald Trump pro-crypto stance, which he made several promises, including making regulatory changes, appointing as well more crypto pro officials, and then a national Bitcoin reserve. So all of these are propelling Bitcoin to these multiple new highs, even though this is a bull market.
Right. We've been hearing about this bull market for the longest time now, but there are different kinds of investors right now. There's some that have been on the sideline holding on to cash. This is not the market for them right now, right?
Our generation, we love volatility. This, I would not say same if I was from the older generation. The older generation don't love large volatility. But then I also think that most persons who may not like this kind of volatility, probably because they are from the older age, actually understand what we are doing, but they are not self-aware of what we are doing, because inflation is highly on the rise. And so, risks always come through the kind of profit you will make. So what I mean is more like is the kind of risks you take is synonymous to the kind of profits that you will as well make. So we are in an inflationary driven environment. And so the younger generation understand that what they need to make, the kind of profit they need to make, need to be able to match the devaluing power of their currency. And so, yes, I understand that this is not the best of time to have been in the market, especially those who have been following this show. They would have known when we started discussing how it was early period investors already entering in, when we discussed about having a margin of safety. But then I still think it's my view that the bull market is still early. This is still the early phase of the bull market, and all investors who are on the sideline need to look for is a good entry level. And will be part of the more rally that I expect to still come in.
Because some would argue that there's not much, profit ahead right now for Bitcoin at these levels, and maybe at some point the only way might be down.
Okay, no, personally, for me, it's my view, Bitcoin is still very, very undervalued, and Bitcoin is going to be way more valued than gold in the future. So their perspective to all of this, if you're looking at the longer term, when we started this journey in the cryptocurrency space, this is history. At a time where countries will already be preparing for their Bitcoin reserve stockpile, where we'll see regulatory framework being built for this. So when you're able to look at the future and understand that Bitcoin is digital gold, you see how very undervalued it is. But then if we are looking for profit potential for this bull market, I actually think that Bitcoin still have some nice profit level is still going to get into. But then, of course, the more bigger the price, you understand that the kind of amplified return that asset will come with will always be low. But don't also forget that Bitcoin giving you more like a nice and decent return also means that the risk it comes with is not very, very high. So for investors who want to be exposed to more risks, they could dive into other cryptocurrencies, but Bitcoin comes with more of a promise of safety as well as profits.
All right, we'll see if Bitcoin still has more legs in this bull run. Thank you so much, Gilbert Jokpata. Always great having your perspective.
Yeah, thanks for having me.
All right, so that's how most of the markets we track are looking at in this TGIF trading. I'm sure Bitcoin seems to be having most of the fun right now, but you can watch this again on our YouTube channel. Just flip over to YouTube, search for Channels Television. You can also follow the conversation on X and our website, www.channelstv.com. Thank you so much for watching today. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.